Welcome to The Explainer. Today, we're going to break down a corporate action that sounds super complicated but is actually super important for investors to get a handle on, the rights offering. And we're not just going to talk theory, we're going to use a real-world example to see exactly how it could impact your portfolio. So, here's how we're going to tackle this. We'll start with the absolute basics. Then we'll set up a scenario with a hypothetical investor. From there, we'll crunch the numbers to figure out the new share price, and then, this is the fun part, we'll explore two different paths our investor could take. Finally, we'll see what it all means for their bank account. Ready? Let's get into it.
All right, let's dive right in. First things first, what in the world is a rights offering? Let's get down to the fundamentals.
You can think of it like an exclusive VIP offer just for a company's current shareholders. It gives them the right, and notice, it's not a requirement, just a right, to buy more stock, and usually at a pretty sweet discount compared to what everyone else is paying on the open market. Okay, to really get a handle on this, theory isn't enough. We need to see it in action. So let's follow a single investor as they navigate a rights offering. Here's the situation. So here's our investor. They're holding 42,000 shares in a company. Right now, each share is trading for 750 shekels. Then the company announces the offer. For every 2 shares you already own, you get the chance to buy 1 brand new share for only 675 shekels. A nice little discount, right?
So the crucial point here is, before anything happens, before a single decision is made, their investment is worth a grand total of 315,000 shekels. Remember that number. It's our starting line.
Now, whenever a company starts issuing new shares, especially at a discount, it's going to have an effect on the stock price. So our first job is to figure out what the new, theoretical price will be after the offering happens.
Whoa, okay, that formula looks a bit scary, right? Don't worry, it's not nearly as complicated as it looks. It's basically just a weighted average. Let's break down what each of those letters actually means. See? Not so bad. P is just the current market price, our 750. PR is that special discounted price, the 675. And N1 and N2 are just the ratio of the offer. 2 old shares for 1 new one. That's all there is to it. And when we pop those numbers into our formula, boom, the new theoretical price per share comes out to 725 shekels. This makes total sense, right? The company is adding cheaper shares into the mix, so the average price naturally comes down a bit. This 725 is now the new reality, and it's the price we'll use for everything that follows. All right, our investor has a choice to make. Let's look at option A. They decide to go all in. They're going to exercise every single right they have and buy as many of those discounted shares as they possibly can. What happens then? What, with 42,000 existing shares and that 2-for-1 ratio, they get the right to buy 21,000 new shares. To do that, they're going to have to write a check or, make a transfer for an additional 141,750 shekels. So after they make the purchase, their total holdings jump to 63,000 shares. And at that new market price we calculated, 7.25 shekels, their total portfolio is now worth 456,750 shekels.
And here is the aha moment. This is the key. Look at those numbers. On the left, you have their original investment plus the new cash they put in. That totals $456,750. On the right, the final value of their portfolio is exactly the same. Their net worth hasn't changed by a single shekel. They haven't made or lost money, they've just changed the form of it. But, what if our investor doesn't have an extra 140 grand just lying around? Or what if they just don't want to increase their investment in this one company? Well, there's another option. They can take a kind of hybrid approach. So in this scenario, let's say the investor decides to exercise just 25% of their rights, and they're going to take the other 75% and sell them on the open market. Yeah, you can do that. So this is a two-part move. On one hand, they invest a smaller amount of cash to buy some of those new shares. But on the other hand, they receive cash by selling the rights they decided not to use. So you might be wondering, what's one of these rights actually worth on the market? Well, the value is simply the gap between the new share price and that special exercise price. In our case, that's 7.25 minus 6.75, which comes out to exactly half a shekel per right.
Okay, let's do the final tally for this option. You've got the value of all their shares plus the cash they got from selling their extra rights. You add those two together, and their total assets now come to just over 350,000 shekels.
And would you look at that? It's the exact same story all over again.
The final value of their total assets, their stock plus their new cash, is identical to their initial portfolio value plus the smaller cash investment they made. The math works out perfectly again.
So after all that math, after all these calculations, what's the actual bottom line? What's the big takeaway for you as an investor when you see one of these offers come across your screen?
The core principle, the thing you have to remember, is that a rights offering is designed to be a value-neutral event. It's a bit of financial shuffling, but it doesn't magically create or destroy wealth by itself. Think of it this way. Your slice of the company pie gets bigger, but the pie itself gets repriced.
And this leaves us with the final and maybe the most important question. If your net worth is going to stay the same no matter what you do, what's the point? The decision isn't about making a quick buck. It's strategic. It's about asking yourself, do I believe in this company's future and want to double down on my investment? Or is this a convenient time to take a little bit of cash off the table without selling my shares? That is the real decision at the heart of any rights offering.